Quite a few of you asked for us to cover Fluence Energy, so that's what we're going to do today. The last time we looked at this firm was last October, and the thesis is pretty straightforward. So you have a large number of renewable energy projects out there, solar and wind. Well, the sun doesn't shine at night and the wind doesn't blow all the time, so you need energy storage solutions. And Fluence Energy was born from AES and Siemens, two pretty big firms, and the company had an IPO. They didn't choose the SPAC route. And what we found attractive, aside from the obvious energy storage thesis, was that they had this AI forecasting tool that energy owners could increase revenues by double-digit percentage simply by forecasting energy prices. And it was supposed to be 90% accurate, which is quite remarkable. So we found Fluence to be an interesting company, but we had some questions around their revenues in terms of geography and also whether or not their recurring revenues would be meaningful. And I think some of these questions we're still not able to answer, but we're going to look today at some reasons why we wouldn't invest in Fluence Energy stock. So as we said, the thesis is pretty straightforward. You have these energy storage solutions. They've deployed quite a few of them. Revenues are growing quite rapidly and everything looks good. But the first problem that we run into, and when you're screening stocks, you always want to try and find the red flags as quick as possible, so then you don't have to waste time researching a whole bunch. You find some red flags, and then you can dismiss the company as something you wouldn't invest in. Now, we're going to mainly focus today on this gross margin concept, and it's something we talked about before. In a recent piece, we looked at how 4 of our 6 lowest gross margin stocks of the 35 tech stocks we hold were green tech stocks. Well, that's a story in itself, but when you look at the gross margins for Fluence, so the top table here shows the revenue and COGS for last quarter. And you can see that when you're producing a product that costs more to produce than what you can sell it for, that's not a very sustainable business. And the reason that Fluence gave for this would be project cost overruns. Well, that same reason was used in 2021 to explain why the COGS exceeded their revenues. And you can see that the year prior to that, the gross profit was only 1.4%. That's a very small margin of error. Now, when we look at how the company explains why the gross margin was low in 2021, we see that they had some issues here. So capacity constraints within shipping, increased shipping costs. I think they said the shipping was increased by around 24 million, both caused primarily as a result of the pandemic, which is now several years old and is still creating problems because of something called the bullwhip effect in supply chain. So you could argue that perhaps that's temporary. Then we have a second item here, cost overruns, delays, and other project charges we're experiencing and some projects under construction. That's a problem because we see that this past quarter, and we also saw that in 2021. And if it's enough, that single issue is enough to affect gross margins this past quarter, then when are they going to be able to manage these cost overruns going forward? What assurance are we given that these won't be an issue going forward? And then they have this cargo loss incident cited, which indeed is something that hopefully doesn't happen very often. Now, the company lists quite a few variables that affect gross margin, and a number of these aren't really controllable. So you have product prices, sales volume. When it comes to pricing, we're curious on the contracts that they have in their pipeline that they need to deliver on for the coming years, how fixed those prices are. In other words, if they quote their customers a particular price and they need to deliver on that, well, what happens when they go to create the products and the materials have increased? Can they pass those costs on, or do they just lose money? Is that referring to the project cost overruns that they talk about? You have product costs. So lithium battery prices expected to increase. We'll look at that in a second. And they have steel and aluminum supply costs, inverters, casings, fuses and cable, and all these can expected to increase because of inflation, and everybody else providing the same reasons around the COVID pandemic increasing prices and making it more difficult to deliver products. Product mix, we're going to touch on that. And you have customer mix, geography, shipping method. We talked about that. Shipping costs have skyrocketed. Maersk's results have just been phenomenal. You have warranty costs. And we had a question here around their exposure to third-party components. So they have battery suppliers, and they have had some overheating problems. We're going to talk about that, are somewhat concerning. And then seasonality. This is just worth noting that their 80% of their total order intake is in the third and fourth fiscal quarters. So that just means you won't have nice, smooth quarterly revenues to look at. Now, here's something that we talked about in our research piece before, which I will link to in the description of this video, and specifically mentioned that these segments can potentially solve the gross margin problem. So you see they have energy storage products. All right, even if you can't make it a profit on those, perhaps the service contracts can be profitable. And then these digital contracts, that refers to these software companies they've been buying and the AI forecasting tool that we talked about. So they've broken these out in terms of megawatts. We'd like to see this broken out in terms of revenues and cost of goods sold. Then we can see that digital contracts are contributing to gross margin. There's growth there. And then we can see a path forward to sustainable profitability for Fluence Energy. Until we have that, we don't really know what sort of contributions are happening here. So getting back to lithium battery prices, this is an interesting tidbit in their 10Q. The price survey from Bloomberg says that for the first time since 2010, the average price of a lithium ion battery pack is expected to rise from $132 per kilowatt hour to $135. So a small increase, but again, the first time the price has increased since 2010. So that's something that needs to be taken into consideration. Now, when we look at concentration risks for Fluence, one customer accounted for approximately 70% of their total revenue. Now, for us, that's a showstopper. We don't like to see a company that's that dependent on a single customer. And when you look at this second bullet point here, for the 6 months, and this would be, well, let's see, that's actually in 2021. Our top 3 customers in the aggregate accounted for approximately 77% of total revenue. So what's happened here, it appears, is that a single customer now accounts for a great deal of revenue, and some others perhaps fell off the cliff. So a company will typically note if a particular customer accounts for 10% or more. So the fact they have a single customer last quarter accounting for 70% of total revenue is a big concern. They also cite a limited number of suppliers for batteries, which is a major component of their energy storage products. Now, if you're wondering about who that big customer is, well, it's probably one of these 2 firms, AES and Siemens. So related parties. We've talked about this before, and it's a problem for companies like Ginkgo Bioworks that create other companies and then have them give the money back. Or you see in the case of Palantir, they go out and find SPACs to buy their product, invest in the SPAC, and the SPAC gives them the money back. So in this case, it's a bit different because these are 2 major shareholders, very large firms, each holding 58 some odd million shares in Fluence Energy. So they are related parties for that reason, and one of them seems to be contributing a great deal of revenue. Here you can see last quarter how revenue from related parties made up about 66% of all their revenues. Is that a concern in the same way that we were concerned about Ginkgo and Palantir? Not really. It's more of a concern that you have such a large percentage of your total revenues coming from a single customer. So that's something worth noting. We also picked up on the overheating incidents in their last 10Q. The fact that they list them in there means that they could potentially have a meaningful impact on the company. This first item, in September of 2021, they had a 300 megawatt energy storage facility experience an overheating event that was built in 2021. The customer says that Fluence is liable based on their investigation. Fluence denies responsibility and is continuing to investigate the incident. So we don't know what the outcome of that will be. But then we have another event here in April of this year. a 10 megawatt energy storage facility owned by AES, so that's notable. A related party is likely to, let's say, be less strict in the courts because they hold shares. So maybe that's something that they'll be able to sort out without having to go into a courtroom. But this facility was built in 2019 and now it's having an overheating event. Well, what happens if they find out that their battery supplier is responsible for that and suddenly they have all these deployments that they need to switch batteries out? We just don't know enough here. And this goes back to when we look at variables affecting gross margin, warranty costs. So they need to solve this problem, and we don't know what the impact will be. And when you're running a ship with such tight margins, this could potentially be a problem. Now, increasing gross margin over time, this could happen through a number of different avenues. So they could acquire software companies, as they have been doing, and have a high margin recurring revenue stream complement their low margin hardware business, which is what they seem to be doing. We need to see more color as investors. We need to see how that's working out. They can control some of those variables, not all of them, but perhaps they could vertically integrate and reduce some of the potential liabilities they have from um, the aforementioned supplier concentration risk. So there are ways that over time they can increase that gross margin, but we don't want to invest in a firm that where we're waiting for that to happen. We would have liked to already see that happen. Now, when it comes to our own renewables exposure, we did a analysis of gross margin in our portfolio recently, and we published a piece on this. It's also a video on YouTube. And 4 of the 6 lowest gross margin stocks we hold are green firms. And 3 of those are related to renewables. So we have a solar hardware company. We're holding the largest renewable energy company in the world. And we're also holding a battery supplier. That battery supplier is Enersys. And energy storage we find to be a pretty compelling theme as a way to play renewables, a pick and shovel play. And when we looked at Enersys, they were pretty compelling, but they don't really have the exposure to lithium batteries that we'd like. So ideally, we want more of a focus on lithium battery growth. A high margin SaaS business would be ideal. So we're open to substituting our holding in Enersys with a exciting energy storage company. Well, Fluence Energy isn't that substitute for the reasons that we've talked about today. So just to conclude, Fluence has about 12 months of runway according to the firm, which represents $723 million in cash on their books. And then they make this statement about $2.1 billion of remaining performance obligations relating to their contractual commitments, which they expect to recognize 91% of that revenue in the next 5 years. So this is that strong growth that you're seeing. But this last bullet point probably sums it up. It says contracted backlog and pipeline may not generate margins equal to our historical operating results. So there are just too many variables that could potentially affect this firm's already very, very tight gross margin. And until we can see some progress, a breakdown of the high margin components of their business so we can monitor that, it isn't something that we would touch. We would avoid this stock. So please put your comments in the comment section. Thank you very much for taking the time to watch this video today.